Good morning, everyone. Good afternoon, good evening, wherever you are. We are starting, and we are honored to have our first keynote speaker today. It's my pleasure to introduce to you Professor Sajajit Bose. Professor is teaching sustainable investing, cost-benefit analysis, and mathematics. He serves as an associate director of the program in sustainable management. His research interests include value of ESG, that is environmental, social, and governance information, carbon pricing, the link between portfolio investment and sustainable development in emerging markets, and the optimal use of environmental performance metrics for long horizon investment choices. He is a co-author with Dong Guo and Ann Simpson of the Financial Ecosystem, the role of finance in achieving sustainability, which was published by Palgrave Macmillan in 2019. His other research is available at the Research Program on Sustainability Policy and Management at the Earth Institute. Sajjait has extensive expertise in investment banking, asset management, financial restructuring, and automated weather risk management. Among other positions, he was a mergers and acquisitions banker, directed quantitative trading strategies at a convertible arbitrage hedge fund, managing $1.5 billion in assets, and developed machine learning algorithms to optimize weather-based decision tools. So that's our speaker today. Professor, please speak to us. Thank you.
Thank you, Dr. Duncan Ellie. Can you all hear me? Yes, thank you. Very honored and privileged to be speaking with you all today. I wish to thank the organizers of the conference. Thank you especially to Dr. Ellie and also to Pauline Mutoni, who wrote to me a few months ago and invited me to speak at this conference. I'm speaking to you from New Jersey in the United States. I've never been to Kenya, but I feel that I have a connection with Kenya. I should tell you that I spent 10 years growing up in Southern Africa, in Zambia and Zimbabwe, the most formative years of my life. So the last years of primary school and all of high school were spent in Zambia and Zimbabwe. And when I was studying in high school in Zimbabwe, of course, you know, it was soon after independence in Zimbabwe. So the understanding of anti-colonial fervor was important at that time. And some of the people that we learnt about in our history classes were Dedan Kimathi from Kenya, the great freedom fighter. I hope one of these days that I'll be able to visit Nairobi and go and look at the statue at Kimathi Street. And also the Mahdi in Sudan. I was able to visit Khartoum in 2019, just before pandemic. In high school, we also read Ngugi wa Thiong'o's A Grain of Wheat, a story of betrayal and remorse. No one can forget the character of Mugo. I'm very grateful. I listened to some of the talks yesterday. Very grateful to Professor Abdul Karim Bangura's talk about decolonizing our minds. And he brought up Sheikh Anta Diop, whose work I have been heavily influenced by. Sheikh Anta Diop wrote that Greek civilization is a pale copy of African civilization that developed in Sudan and Egypt and spread throughout sub-Saharan Africa. And he wrote that Pythagoras, you know, the mathematical theorem, the Pythagorean theorem, that the square, the square of the hypotenuse. Pythagoras spent 22 years in Africa learning his science before he went back to Greece. And Plato spent 8 years in Africa before he went back to Greece, learning science. I spent 10 years, so I'm behind Pythagoras, but a little bit ahead of Plato. So with that, let me talk to you a little bit about some of the things that I've been learning, and I hope to spend a lot of time with you on Q&A so that I can learn a little bit more about the financing obstacles in Kenya and more broadly in developing countries. But I want to share a screen with you. I have some slides. So maybe let me see if I can share my screen here. Okay. Okay. So I'm going to talk to you a little bit about the financial ecosystem, what finance is for, speak to you about sustainable finance. I don't want to take up too much time talking, so I have a lot of slides here. I will not go through all the slides. I will draw a little bit of a narrative, and then I will wait for questions, and hopefully we will proceed that way. A lot of the ideas that I'll be talking about today are in this book called The Financial Ecosystem, which is available in PDF forms for free through many university libraries. Okay, so, what is the role of the financial system? In capitalist economies, now most economies around the world are mixed capitalist economies. The role of the financial system is to do two things. One, it's to allocate capital. We all know that you might go to a bank or to a stock exchange to raise capital. And that's a well understood role of financial institutions. But actually, a more important role is that of gathering decentralized information about potential investments. Its role is to understand which investments will generate return and which investments will not generate return, which investments generate enough return to compensate for risk, and which investments do not. And that role is a very important societal role, because what it does is it ensures that capital, which is of course scarce, is utilized in productive endeavors. And let's ask, what is capital? Where does the capital come from? That capital consists of the savings of households, of workers, of taxpayers, people that we call the citizen investor. This is a very important notion. When you think about the huge amounts of capital in the world, the capital that owns the major corporations around the world, the capital that owns large infrastructure projects, that capital doesn't belong to a few rich people. It belongs to the citizen investor. Most of the ownership of the world's largest corporations has shifted from wealthy individuals to institutional investors. And who are institutional investors? Institutional investors are pension funds, sovereign wealth funds, mutual funds that pool the assets of the middle class. Now, Kenya doesn't have a sovereign wealth fund yet, but I know that it is in the works. Nigeria has a very important sovereign wealth fund. Most of the countries around the world have sovereign wealth funds. These are funds that own securities, often debt and equity, on behalf of the citizens of their countries. Pension funds own debt and equity on behalf of the beneficiaries of that pension fund system. And this capital has an enormous amount of power. When you ask people, when you ask those investors, what are the most important company behaviors and what behaviors have the most positive impact on return? You will find, this is a survey from last year, you'll find that investors understand that social responsibility is considered important by the majority of the people, 70% of the investors. This is not ordinary people. This is not the person on the street. It's the actual investors of this capital. They say that social responsibility is important and it has the most positive impact on financial return. Yesterday, we saw a paper by Zainab, which talks about that for the Nigerian Stock Exchange. What about other things? Attention to environmental issues. This is considered important by the majority of investors, both for return and for company behavior. Treatment of staff, closing the gender pay gap, addressing pay gaps between top executives and other employees, and diversity of the company's workforce. Gender, ethnicity, age, sexuality, socioeconomic background. These aspects tell you that investors care about things that are not just financial return. We also understand today that capital comes in many forms. It's not just financial. It also consists of manufactured capital, intellectual capital, human capital, very important social and relationship capital, and natural capital. All of these other things, so manufactured capital, human capital, social capital, and natural capital, and intellectual capital, these actually create wealth. Financial capital doesn't create wealth, it simply allocates it. So these other forms of capital are more important than financial capital. Now, let me also talk a little bit about the recent discussion, which is a differentiation between corporate social responsibility and corporate shared value. So the understanding, we have to move away from an understanding of corporate social responsibility as giving back. You know, many times you'll hear people say, what is corporate social responsibility? It's a corporation that makes money within society and then chooses to give some of it back to society. That is the wrong view of corporate social responsibility. The reality is, it's not the corporation that makes money and then chooses to give some of it back. It's not charity. The corporation cannot make money unless they have the support of society. The corporation makes money with the permission of society. It makes money because it can create value, shared value. So, you know, this is why we make the distinction. A corporate social responsibility assumes that the corporation is doing good by giving back to society. But corporate shared value understands that the corporation can only generate value if it creates goods and services that have economic and social benefits relative to the cost of producing them. So corporate shared value is not separate from making profits. It's integral to profit maximization. It's not a distraction from competing with other companies. It's integral to competing. Without corporate shared value, you cannot generate profits. So I think it's important to understand that the outcome variable, the dependent variable yesterday in Zainab's paper was return on assets. And the input variable was a measure of responses to a questionnaire about corporate social responsibility. Those two things are intimately linked. A company cannot generate return on assets unless its workers, its customers, the communities in which it operates, and the government are helping it make that money. Okay, here's something to understand. Today, there is an abundance of financial capital in the developed world. Interest rates are very low, and in real terms, they're negative. Since 2009, we've had this phenomenon of quantitative easing, which consists of major central banks around the world printing money, in effect, generating loans to financial institutions collateralized by any paper assets they may hold, whether they are of value or not of value. So it's easy to receive money in the developed world today if you're a financial institution. There's no shortage of capital. There are also aging populations in the developed world. These aging populations, it's very typical, if you look at a population that is aging, that they will have a lot of financial capital. They don't have much human capital. They don't have that much to live. But they have financial capital because they've saved throughout their lives. And so when there's an abundance of financial capital, interest rates tend to go down because there is a large number of people with a lot of paper money who are looking for investments that will generate income to tide them in their retirement years. That is not the case in sub-Saharan Africa. It's not the case in India yet. And so the countries without these aging populations, they will be receiving that demographic dividend. Kenya is one of those countries. Ethiopia is one of those countries. Sudan is one of those countries. And it's very important to understand that what these young countries have is very valuable. So if you are a young person in Kenya that works hard, that studies hard, that wants to gather knowledge, you are very valuable. You're very valuable to your country, and you should not think of yourself as being comparable to the pieces of paper on which is painted the currencies of various countries. Those currencies are just that, they're pieces of paper. They're not convertible into gold. They are just pieces of paper that we believe will turn into something useful. And in return, we often give up our best human capital or our best natural capital. That is a fatal mistake. You will see, for example, that the ratio of asset value to GDP in the world as a whole has grown from 6.5 times in 1990 to 10 times in 2020. 1990 is the year I left Zimbabwe and went to study in New York. So what does that mean? 6.5 times to 10 times, that means the value of paper assets with claims on GDP has gone up by more than 50%. But GDP, of course, this is a ratio. So if GDP were to be normalized to the 1990 levels, the value of that paper asset has gone up. But that doesn't, what that means is that what is scarce, it's the GDP that's scarce and not the value of those paper assets. Okay, so in this time, we have this development of sustainable capital. We have the growth of the socially responsible investor. This is the fastest growing form of capital. We've seen growth throughout the developed world, throughout the G7 countries. And what does it consist of? It consists of negative exclusionary screening, screening out companies that engage in social ills. Positive or best-in-class screening, investing only in companies that are ESG leaders. There are also other forms of investment that I won't go through now, but you can see that these are efforts to fund activities which are not just about making money, but also about providing value socially. We all know the Sdgs, and the Sdgs were formulated in 2015 as a global dream. You know, we've heard of the American dream, we've heard of the Chinese dream, and the Sdgs represent a global dream. There are 17 goals, and these 17 goals represent, the achievement of those goals represent the desires of people around the world. Before the Sdgs were formulated, the UN organized what has come to be known as the My World Survey. The My World Survey. This is the largest survey ever undertaken in the world. It's a survey asking more than 1 million people in 194 countries. What are their priorities? What are their needs? What do they need to make their life better? They were asked to choose 6 out of 16 possible issues that would make the most difference to their lives. And, you know, unlike other surveys, this one is 80% from developing countries, 53% male, 47% female. relatively balanced. Full 37% had no education beyond primary school, and 68% under the age of 30. So this is a survey whose respondents, or the demographic characteristics of those respondents, look like the world as a whole of 7 billion people, not the world that we see in the G7 countries of 800 million people who are relatively rich and relatively old and relatively educated. So let's ask, what do these people want? This mass of humanity that we care about? Well, let's look at that survey. Okay, the number one thing they care about is a good education. They believe that a good education will improve their lives most. Better healthcare, better job opportunities, an honest and responsive government, access to clean water and sanitation. These are the top 5 priorities. You can see what's at the bottom. Action on climate change, reliable energy at home, phone and internet access, political freedoms. So the world's ordinary people are telling us that we need to fund a good education, better healthcare, better job opportunities, an honest and responsive government, and access to clean water and sanitation. So those are the priorities of the world. And those are the priorities that the financial ecosystem, which circulates capital from households to firms and governments, needs to serve. The government's job is to protect natural capital. It's to protect human capital. And in return, households pay taxes to that government. And households also buy goods and services from firms. They receive wages for human capital services that they give to those firms. The financial ecosystem sits as an intermediary, a middleman. And the middleman role is a very important one. It can easily be abused, but it can also be very beneficial. It's a very powerful role. I'm giving you a quote from some testimony by Mariner Eccles, given to the US Senate Committee on the Investigation of Economic Problems in 1933. 1933, the US was in the middle of the worst depression ever, the Great Depression. And the question that he was addressing was, how can we ensure that we come out of this depression? And he talked about the savings cycle. And he said the rich can save. They can save all they want. They can save idle factories, useless railroad coaches. They can save empty office buildings, closed banks. They can save paper evidences of foreign loans. But as a class, they cannot save anything that is worth saving above and beyond the amount that's made profitable by the increase of consumer buying. The idea is that a nation becomes wealthy because of its ordinary people having choices. A nation, this goes back to Adam Smith. Adam Smith wrote in detail that the reason a country is rich is not because its rich people are rich, but because its poor people are rich. And it's their ability to have a good life that funds a vibrant economy. So savings circulate from the household to the governments and to the firms. And that circulation of savings breaks down if you have a significant leakage to foreign deposits. You can have significant leakage, both financial, savers. As I said, I lived many years in Zimbabwe. My parents went through hyperinflation there. We know what it's like when people who save have to send their money overseas because the currency is not stable. But not only are they sending their money overseas, they're sending their children, they're sending their human capital, the most valuable capital. They're sending their natural capital by extracting resources in a dirty way and destroying water supplies or the land. So wealth destruction occurs. Also, storage of wealth in cash is a problem because cash is not usable by others. If you cash is only useful to society in circulation, not in storage. Okay, I'm running out of, let's see, what I want to do is also highlight that, of course, you have high capital flight in sub-Saharan Africa. You have low to negative real interest rates, because even though you have higher interest rates in the developing world than in the developed world, you also have high inflation, a debasement of the currency. Underdeveloped banking sector, which lends to companies that already have access to capital, not to companies that actually need capital. You have limited SME finance. And you have commodity price volatility. Kenya derives most of its earnings from the agricultural sector and some oil refining and also tourism. So the agricultural sector, tourism, these are subject to heavy price volatility. In the case of tourism, not so much price volatility, but as a result of the pandemic, quantity volatility. I'm going to skip some of this and just talk about two things, and then I'll stop because I don't want to go through everything here. But what's important to understand is that financial value is created by human capital, by natural capital, by stakeholder relations. This is a study done by Alex Edmonds, who's I think at the London Business School these days. What he noted was that shared value, we know, is a requirement for corporate success. What does that mean? That means that the workers in a company must be treated well. So he looked at, there's a Fortune magazine, which is a business magazine in the US, and every year Fortune magazine publishes the 100 best companies to work for in the US. And so he said, well, let's imagine that as an investor, I choose to invest only in those 100 companies, no other companies. The S&P 500 is made up of 500 companies, but I won't invest in all 500. I'll only invest in the 100 which are listed as the best companies to work for. Every year, I'll invest in those, and when the new list comes out, I will sell the shares in the companies which didn't make it to the list and buy shares in the new companies that entered the list. If I followed that strategy, then I would have made an excess, a risk-adjusted excess return of 3.5% annually for the last 25 years. This was his study in 2011. Okay. And that 3.5% is a huge number. When it's compounded every year for 25 years, that's very significant. And it's not just 3.5%, it's 3.5% over and beyond the normal return for the stock market. So you can see that investing in companies that treat their workers well pays well. And today we have good information. It's very easy to know which companies treat their workers well with things like Glassdoor, for example. Let's also look at another paper by Yawen Jiao. And this paper looks at stakeholder welfare. So not just employees, but a range of stakeholders. So customers, employees, governments, communities. And he uses information around scores and shows that not only are these companies giving better returns, but they also are priced better. They have a higher price to book valuation, a difference of 1 times to 1.6 times. So it's a very significant difference. And again, we have today good information about the stakeholder relations of companies. So you can see that investing in ESG is helpful for financial return. I'll just tell you one more thing. You could say to me, hey, these are stories about the developed world, the G7 countries. That doesn't apply here in Kenya. Well, that's not true. It turns out that the relationship between ESG and corporate financial performance is strong and positive throughout different regions, and actually it's highest in emerging markets. See? So it's highest in emerging markets. So this applies, and actually the reason it's highest in emerging markets is because there is less disclosure in emerging markets in general. And so in that context, ESG information is much more valuable for an emerging markets company than for a company in a G7 country. Okay, I'm going to stop here because I want to stop for questions and make the discussion much more interactive. So let me stop sharing the screen. Stop share, and let's see if there are questions.
Hi, Prof. Bose.
Hi, Wycliffe.
Thank you so much for sharing. I joined when you had started, and I managed to get something out of it. Actually, what you're sharing is really highlighting. And you shared something about Zimbabwe. You're in Zimbabwe during
Yes.
the hyperinflation.
Yeah, so actually, my parents were in Zimbabwe during the hyperinflation, but I had already left and I was studying in the US. But of course, I felt the effects because of the hyperinflation.
Most of us in our economy, like Kenya, we have never experienced hyperinflation. So maybe can you tell us what is it, the effects?
Yes.
The effects of, because you have
yes.
firsthand, you experience it personally.
Yes, I've experienced it personally, but also, of course, I have studied economics for a long time, and so that is a very important topic in economics. The thing to understand about hyperinflation is it is caused by excessive printing of money. So if you think about money, what is money? Money is really trust. Okay? Most countries around the world, in fact, all countries around the world today, we use paper money and we use bank loans. Most of us who have bank accounts, you can write a check to pay somebody. And when you write that check, all you're doing is writing on a piece of paper, and that piece of paper transfers some money from one person's account to another person's account. There's no actual transfer of gold or underlying value. So and people accept that. Within a country, they accept that because it's a way to make payments. For example, taxes are generally paid in the legal tender. So even though money doesn't have any intrinsic value, we accept money because we know that it can be used to pay taxes. It can be used to buy basic necessities that we need. And in the case of Zimbabwe and in other countries, there's been hyperinflation throughout history, in Germany, in some Latin American countries. even in the United States in the 19th century. The hyperinflation results because of too much printing of money compared to the trust that economic actors have in the system. So once people start to see that money is being printed, what happens with printed money? It's usually printed by the government or an agent of the government, like a central bank. And then that money is used typically by the government to buy goods and services for itself, to pay its soldiers, to possibly to build roads. But often, so here's the thing, if the government prints money to build roads, and that road is used by people to generate wealth, there is no problem, because that road is valuable to society. If the government prints money to pay its soldiers, and those soldiers go and fight a war, and that war is lost, then that money is useless. The money will have been printed and used for no good purpose. It will not have created wealth. And what are the effects? That's the question you asked me. Well, the effects are, most people, ordinary people, they actually save in the form of money. They don't have the ability to save in the form of stocks, because in the US, the stock exchanges are relatively easy to access, but in many other countries, that's not the case. There are only a few companies. It's hard to access, and it's hard to know which companies are good. So most people save in the form of money which is not immune to inflation. They cannot save in the form of gold. They cannot save in the form of copper. They cannot save in the form of barrels of oil, because they don't have a warehouse in which to keep that barrel of oil. So most people are heavily hurt by hyperinflation. It makes, so in my case, my parents, my father worked all his life as an engineer, and he had a pension fund, and that pension fund was denominated in Zimbabwean dollars. So because it's denominated in fixed dollar amounts, it doesn't just go up with inflation. The moment there was hyperinflation, a loaf of bread cost $1 million, and his pension was $2,000 a month. So it completely destroys the savings of ordinary people. Hyperinflation is not usually.
Professor Sajid, as Professor Iraya looks for a good network, there are two questions on Q&A. I don't know if you can access them.
Sure, I can
maybe
see
you can handle them as we wait on that one.
Okay, sure, thank you.
Yes, okay.
Okay, so I see there is a question. How do you explain the abnormal return? For example, the 3.5% you mentioned, more so in markets efficient in pricing assets. This is a question from Otieno Luther. Very important question, excellent question. And, so what does it mean? So do not believe in efficient markets. I have made a living in looking for inefficiencies in financial markets. There are some markets that are efficient. There are other markets that are not efficient. And in efficient markets, there is some kinds of efficiency and other kinds of inefficiency. So you have to work hard to look for those inefficiencies. And actually, one of this, I didn't finish all the slides, but one of the slides talks about how as people start to understand these relationships, then the 3.5% abnormal return will disappear. So when people do not know that human capital, treating human capital well is a source of return, you, by understanding that, can invest in the good human capital companies generate a 3.5% return, over time, that information will spread throughout the market, and then you will no longer be able to generate that abnormal return. So these inefficiencies, they will disappear, but they will be there for long enough. If you're looking for it and you work hard, if you're looking for it, you will be able to make an abnormal return, but you can never rest. You can never say, hey, I found how to make money, and now I can go to sleep and I'll just rake in the money. It doesn't work like that. You always have to be in touch with your investments. You have to know what are the new problems they're facing, and there'll be new problems. What will happen also, I study a lot the relationship between these ESG metrics and financial return. What will happen is that once people start to understand the source of return, they will develop metrics for them. And once the metrics get developed, then it'll be easier to compare different investments. By the time the metrics are fully developed, the inefficiency will disappear. So in life, by the time someone is able to articulate a problem and quantify it and study it statistically, it becomes almost no longer worth studying. So that's an important dynamic, a dialectic that you want to understand about the financial markets. It's only efficient about things that people have articulated and quantified and understood. But until they fully understand it, each individual, each creative mind, and each questioning mind has the ability to look for hidden sources of value and do well from that. So I encourage my students to look for new sources of value. Don't go the same path. Don't go the path that, don't go to the biggest, most rich country. Go to the countries that are growing, the countries that are not yet powerful, the countries where you see innovation taking place. Those are the countries that you want to learn from, because those are the ones that'll have something to tell you. I see another question from Winnie Juma. In your opinion, why are LDCs starved for capital? Aren't they innovative enough? Is it a systemic problem? And what needs to change for the LDCs to have an abundance of capital? Yes, this is a very important question, and I have 5 minutes, so we could talk for many days about this. But one of the things that I see with LDCs is that all their capital gets shipped overseas. The human capital gets shipped overseas. Why? Because the human capital doesn't have value locally. Before the pandemic, my last trip was to Khartoum in Sudan, because one of my former students was involved with the revolution in Sudan, and looking at helping develop a new Sudan with a coalition with the civilians. And it was clear that the Sudan was exporting everything. It was exporting its young people to fight as militias in Libya and in Yemen. Its human capital was being exported, and it was exporting its educated to work in the US or in Europe. It was exporting its gold through Dubai and the UAE. It was exporting its natural resources, and in return, what it receives are pieces of paper that is not convertible into anything. And it has to maintain the value of its currency with huge reserves. There's a lack of trust between the developing countries. So in one of the book, one of the chapters, chapter 9 in this book, The Financial Ecosystem, we talk about the value of network capital, social network capital. It doesn't help if all your connections are with just a few central nodes in the network. If all the capital goes to London and New York, instead of flowing from Nairobi, it should flow to Addis Ababa and back. It should flow to Dar es Salaam and back. It should flow to Harare and back. The trade that takes place is not, you'll notice if you look at the different regions, in Asia, inter-country trade, with intra-regional trade is a very high proportion of overall trade. So trade between countries within Asia is very high. If you look at Latin America and Sub-Saharan Africa, all the trade is with the Western countries, not with each other. That is a major source of capital flight, of all sorts of capital, human capital, financial capital, natural capital. So that's a key issue that prevents the abundance of capital, especially in Sub-Saharan Africa and in Latin America. It's, I have 2 minutes, so let's see if there are any other questions. I see maybe there is something in the chat. This is the emphasis on human capital is important for real sustainability. I think I totally agree with you. Human capital is super important. It's the thing that is most scarce. You know, it's also very easy to waste. Very easy to waste our intelligence and our hard work going down the wrong paths. And so I'm very happy to see in reading about the importance of education for this conference. I was very happy to hear about the talk given about mentorship yesterday and the talk about decolonizing our minds. These are very, very important. You know, we come from a world where it becomes very easy to think that engineering and scientific achievement are really what's important, and not paying enough attention to the humanities, to the lessons that our authors like Ngugi wa Thiong'o give to us. But without that kind of framing, without that cultural understanding, and understanding from Sheikh Anta Diop that our civilization is rich and primeval, and we have to dig deep into that civilization and find our own strength, our own internal strength. Without that, it becomes very difficult to, we're always running, looking for sustainability outside instead of sustainability within. So I'll stop here because it's 4 o'clock for you.
Professor Sajid, I know, Professor, I know it's 4 o'clock, but if Professor Iraya has his network correct, I would beg him to come up again. I would not wish to lose his comment or his question on this. I beg your indulgence. Oh, you are muted. You're muted. Professor Iraya, are you back?
I can respond to what I understood to be his question.
What has happened?
I can respond to what I understood to be his question.
Thank you. Thank you. Respond.
Okay. So his question, as I understood it, is how do we determine when we screen out certain investments, right? We screen out certain investments. How do we determine that those investments would not have helped economic growth? Okay, and this is a very important discipline that we have to have. We do not want to take screening just because of someone else telling us that this is bad. We have to make that judgment ourselves. We have to understand our economy and society, and we have to ask, what is it that we need? And so the idea of screening doesn't mean you take a list that is prepared by, say, the Norwegian pension fund or a responsible investor in Switzerland. That's screening doesn't mean that we have to take somebody else's idea of what is valuable and what is bad. It is up to us as a society. You remember I said, the first thing I said is that the role of the role of finance is to gather information. That means that there is a high load, a high burden for people in finance in Kenya or in Nigeria or in Ghana or in Zimbabwe. There's a high load to understand what is beneficial for that society, what is needed for that society. And if you have consensus amongst your stakeholders that this is something that is needed, then you should go for it. I'll give you an example. In Europe, you think Europe is relatively homogeneous. In Europe, if you go to Paris, then they do not want to touch coal as a form of electricity. If you go to Berlin, they do not want to touch nuclear as a form of electricity. So a French responsible investor will not invest in coal, and a German responsible investor will not invest in nuclear. But the French one will invest lots of money in nuclear, and the German will consider investing in coal. And so it depends on the situation. France has a lot of nuclear power. They also have a source of nuclear raw material from West Africa, their former colonies. Germany doesn't have former colonies, and it has no good source of nuclear raw materials. And so the situation is different, and you have to understand that. You cannot just wholesale import. That's what Professor Bangurat was talking about yesterday when he said decolonizing the mind. You are the sovereign. You have to decide what's right for you. So screening, yes, but you have to go through that process of screening. I'm happy. I see on the chat, Wycliffe is asking about the slides. I'll be happy to send the slides to the organizers, and you're welcome to distribute them.
Thank you very much for this session. I hope you will stay with us and for these insightful discussions. And we will continue having collaborations on these discussions going forward. Thank you, Prof.
Thank you.
Dr. Okiro, over to you.
Stay.
Dr. Okiro.
Thank you.
Thank you, Professor.
I will stay.
All right. Thank you, Professor Sajid.
Good morning, good afternoon, good evening, good night with the sessions. And we are moving to the next presenter, who is going to give us a keynote on industry practice in financing sustainable development. These developments Professor Bose was talking about. How does the industry finance them? And is the financing sustainable? We are borrowing a lot to finance this development. People are always crying that our debt burden is very huge. Will we get out of those debts? So we were privileged to have Esbon Ogundi, who is an expert in the area and is going to take us through. Esbon Ogundi has several years experience. He has over 15 years experience in this industry. He is the founder and CEO of Fairways Green Markets, an enterprise linking farmers to the market and other essential services. Kenya is an agricultural country. We depend on agriculture, and we have a problem on marketing farm produce. So Bwana Esbon is working in that area. and is doing it through digital platforms. So is able to reach the youth. Is also the founder of Growbiz Africa SME. This is for startup businesses. Is assisting to come up. As I've said, is a consultant with 15 years experience in financial management, operations, administration, in non-governmental organizations. Is lastly, I can say that is a consultant in corporate reporting, corporate governance, sustainability reporting. He has worked with the UN bodies, UNCTDA, and he has been a trainer of trainers on matters to do with SMEs, and is also a CPA, is a certified public accountant, is also a certified financial analyst, and many more. I can't finish the qualifications of Esbon Ogudi. So I have this chance to invite Esbon Ogudi to the forum. Welcome, Esbon.
Thank you very much, Dr. Okiro, for such an introduction. I hope you can hear me.
We can hear you. Can you proceed?
Oh, thank you very much. That's an important feedback. I am Esbon Ogudi, a certified public accountant, and I am currently undertaking my studies in an advanced level chartered accountancy with the Institute of Chartered Accountants of England and Wales. That is an ongoing process. And just to correct, I'm not a certified financial analyst yet. That must have been an error somewhere. I'm happy to be part of this panel this afternoon. And I believe I've actually learned so much so far since yesterday. And thank you, Dr. Satyajit Bose, for such an insightful and real-life presentation that you have given to us, especially on the emphasis on the human capital, which for many years and many centuries have been forgotten, and we entered into the capitalist era. And so the emphasis and the discussion on sustainability is very important, even at such a time as this. As much as we are having it late into the years, as we are just about to conclude on the agenda, SDG Agenda 2030. So I hope I will be able to share my screen. When I was asked to make this presentation, I must thank the organizers for such an honor. It's really an honor to be part of these esteemed professionals and academicians. Actually, I could be the only non-academician in this room, and it is an honor. I come from the industry where we have been doing and analyzing financial reports. We've raised, I've participated in fundraising for different organizations, from the non-profit organizations to SMEs. And so it is an honor and a privilege to make this presentation in terms of the industry practice. Dr. Kiro has already talked about where I come from. Fairways Green Markets, which is an organization that we founded actually a year ago, is a social enterprise that seeks to create market linkages, connecting the three critical players in agribusiness food chain. And these are the farmer, which is the very key player, the groceries and the household market. But in addition to that, we are also linking farmers to the agrovets and agronomists, so that the farmer is able to link to the critical service providers. And in addition to that, we are able to help the farmer get what we call soil test on a remote basis instantly. And all these we are doing using technology, and technology has made it possible. So this is only 1 year since we began, and a lot is happening in the background, and we'll be able to look at that as in the next in the next slides. So sustainable development financing in practice, which I would call the industry practice, is quite an interesting thing. I'm not going to go about to go through the details of the Sustainable Development Goals, but we are aware that it was developed in 2015 and to replace the Ldgs. And for me, as we talk about this, I have noted that there have been very concerted efforts to include as many actors as possible in the sustainability action, and there is a need and for tangible sustainability that we can touch, we can see, we can smell. In terms of monitoring, reporting the progress by all players. I have been part of a consultative workshop on enterprise sustainability and SDG reporting that has been organized by UNCTAD since the beginning of the year. And this week, we are having enterprise sustainability and SDG reporting action plan workshop this Friday, 26th of November. And I'm happy to report that, to note that a lot of players are coming on board. I have been part and parcel of FIRE Awards, which is encouraging corporations, including government entities, to disclose and report their sustainability activities in order to attract investors. This, my involvement is as far as 2014, and we actively doing that. In fact, tomorrow, in the evening, we are converging as FIRE Awards evaluators to just compare notes into our experiences into how organizations, entities, especially government entities, parastatals and MDAs are disclosing and reporting their involvement in the sustainability activities in the institutions. I am also enlightened to say that the International Sustainability Standards Board was finally approved, and this was done as part of COP26 event. And this will now enable the creation of a reporting framework on sustainability within the IFRS, which has never been. We've been doing sustainability reporting and international financial reporting using separate frameworks. But now the two bodies are actually going to work towards a similar framework. Now, going back to the sustainable development financing, a few concerns that we need to address, and I believe these are concerns not only to me, but to a number of stakeholders here. And one of the concerns is that the financing for sustainable development goals available to fast track the implementation. And that question, that's a question that we need to answer. if we're not able to answer it now, we need to continually ask ourselves that question and be able to answer it. And in terms of those financing financing sources, are they efficient? Are they effective enough to bring the desired impact of SDGs? Or is it just some musical chairs that are being played by the so-called development partners? Those are questions that we need to answer, and we need to answer them very honestly, so that we do not end up with issues later on where we are likely to end up with, after 2030, we call in another agenda for achieving development goals, after realizing that the SDGs, just like their predecessors, MDGs, have reached their sell-by date, but we did not get to fully implement them. So those are the questions that we need to answer, even as we look at the financing sources. So, and it's good to also to note that sustainable development has many faces. It has had many faces depending on the sector and actors, players involved. And as such, financing options are as varied as the actors involved. We have the corporate social responsibility, we have corporate citizens, we have the value addition and things, the value added statements that are presented to us by different cooperatives. According to OECD, recovering from the current COVID-19 crisis and delivering the 2030 agenda for sustainable development will require all sources of finance, public and private, non-governmental and otherwise, to be mobilized at a greater scale and speed. So what we also note that for the longest time, our governments were the major source actors in the field of development before non-profit organizations or what we call non-governmental organizations joined. And they have since been joined by corporates through social enterprises, foundations, CSR, and sustainability projects. So the current actors in sustainable development draw funding from a mixed pot both locally and globally. And this, according as we are going to see, they have different advantages and disadvantages, as well as different levels of impacts. So just a few of those sources, like the government sources, which are taxed, coming from our taxes. We have development financial institutions, what we call DFIs, which are also players in financing sustainable development. We have impact investors, or the social and impact investment groups. We have also the corporate social responsibilities, the CSR foundations and sustainability programs that are run by corporates and different corporate organizations within the country and outside of the country. We have the non-governmental organizations, grants and donations, which are also available to fund sustainable development. But something else that is normally ignored, and I think we at Fairways Green Markets have utilized that so much, is partnership and collaborations, which is also another source. It may not give you the hard cash, but it has given us the resources to move forward despite our early stage our early stage status. So I will go straight to the DFIs, which are development financial institutions. These are people like Norfund, which provide equity loans and guarantees to businesses operating in the world's most challenging markets. Now, the DFIs are usually a majority owned by national governments, and they invest in private sector projects to promote job creation and sustainable economic growth. So it is open to as many corporates, private sector players as long as sustainable economic growth is being addressed. They interact with the environment in a number of ways. They come in as investors who supply the investment needed to achieve sustainable development. For example, energy efficiency and the rest with agriculture and things like that. They also come in as valuers where they price risks and estimate return. And I think Dr. Satyajit has done a good job on that. So I may not be able to go into details about that. And part of the external funding from the DFIs come from international and regional development financial institutions, such as the World Bank, African Development Bank, East African Development Bank, and the European Investment Bank. These are available on their website. Now, how do they fund? I think that's so important to ask or to answer. How do these people, how do DFIs fund? They can fund projects directly, that are single large projects, or they can fund projects through financial intermediary or investment groups. Financial intermediaries can be the banks themselves, microfinance institutions, who have the capacity to fund multiple projects. And so you will find, for example, the World Bank funding Equity Bank for SMEs, the World Bank funding Cooperative Bank for farmers, or World Bank funding another bank, or let's say, for example, CBA for energy sector. And so anybody who is interested in such a certain sector will be able to apply for that fund, not directly through the DFI, but through the financial intermediary, which is a local bank. So those are just some of the DFIs that we have. And it is important at this juncture to bring the question of why the donor funding is not working and in Africa, because there have been debates. Dandisa Moyo, in her book published in 2005, entitled Dead Aid, indicates that in the past 50 years, more than 1 trillion in development-related aid has been transferred from rich countries to Africa. And has this assistance improved the lives of Africans? The answer is no. In fact, it is stated that across the continent, the recipients of this aid are not better off as a result of it, but much worse and much worse. And this comes to address the issue of decolonizing or de-neocolonizing the mind of the African, to help us think, to help us to start thinking and knowing that solution actually belongs right here. And we will look at that in the coming slides. So one of the problems with donor funding, or why donor funds don't create desired impact, is that in our experience, in my personal experience, is that the programs that donors fund, programs and projects that donors fund are not community-driven most of the time. They are top-down approach. The top-down approach is where an entity or a group of donors or an NGO drafts a proposal, gets the donor fund, and they go to implement. At the point of implementation, they are, the community is not involved. the community is not involved in assessing the needs. It is somebody who thinks that the community needs a certain solution and then go ahead and does a proposal. So a top-down approach has failed. Community involvement would work. And in the implementation is normally budget-driven to fulfill donor requirement. For example, donors have a quarterly cycle. So you find the cycle, the quarter is just about to, we are ending the quarter. We need the money for the next quarter. So quickly we put up a training into a 3-star, 4-star, 5-star hotel, depending on the budget. Draw participants, they fill in the sheets, and they continue to, they participate in an event, draft report. Some of these reports are also, some of them are copy-pasted reports with few modifications. And I have experienced that, like I said. Then there's other issues like high-level corruptions. Mostly implementing officers, the local officers, are highly corrupt. And in my experience as an accountant of 15 years, I have seen this kind of corruption where people are very greedy to fill their stomach and to build palatial homes when and they're drawing that from the donor fund and are able to fill in reports, copy-pasted reports to make the donor feel that they're actually doing something on the ground. Yet what we say, like we say in Kenya, kwa ground vitu ni different. And another experience, another reason why donor funding do not create the desired impact is majority of funding don't reach the ground. Between 15 to 35%, it's only between 15 to 35% reach the ground to where they are supposed to the work that they're supposed to be done. Fundraising costs take the biggest chunk, and you find certain funding organizations, let's say a funding organization in UK, has their office in Nairobi. So when they do fundraising in the UK, like almost 40% remain in the UK office. 60% come to their Nairobi office, and only between 15 to 35% get to the program. And I say this because I have also participated in looking at financial reports of various organizations, and you can see that glaring disparity from the rest funds to the actual money that goes into the programs. So those are some of the issues that why most funding do not achieve their desired objectives. Aid can increase the dependency of LDC on donor countries. Sometimes aid is not a gift, it is a loan. And poor countries may struggle to repay, and that is the reality. But going back to the dependency syndrome, when we started Fair West Green Markets, we're still pretty new, and we went down, I personally went down together with my friends to gather information from farmers. And I will not say which part of the country, we went to different parts of the country. And one of the things that we realized, because we were very clear that we are not a non-profit organization. So we are a social enterprise. We are a for-profit organization. We are charging for trainings and things like that. So for things, when people heard that you are charging for training and you're not giving them money to attend training, they would boycott. They would not come for the training. And that dependency syndrome, the dependency on donor funds, has been created because they know from practice, donors organize training and then they are paid to attend those training, and there is snacks and there is food. And they, at the end of it, they will be issued with certificates, and of which certificates they can present as trophies that I attended training. And some of them use them in their places of work to get promotions. And we were very clear to them that whatever we are going to train you, unless you implement it and show us that you have implemented the new practices, the farming practices that we are teaching you, we're not going to issue it with any certificate. And a lot of them were very unhappy with us. It may not reach the few people, the people that need it the most. I think we have talked about that. But there are other things, lack of accountability and governance systems is another issue that needs to be dealt with. As much as we have a lot of money, there's a lot of money that's available to fund, especially now that the sustainability agenda is heightened, the discussion, and especially hot after the heels of COP26. We have a lot of money and a lot of players that want to invest in sustainability. But if there is no accountability and governance systems and structures, you are not likely to get funding. And even if you get funding, you are going to collapse as an institution because of that. This has affected many organizations and many institutions today. So apart from the DFIs, the donor funds, and the government, there are emerging and innovative financing options that are coming up. Some of them are not, many people may not be aware of, but we are going to look at them. Some of these are the impact investing, for example. Impact investing is a strategy that targets companies or industries that socially produce or that produce social or environmental benefit to the community. So some impact investors would seek to support renewable energy, issues of electric cars for the different places, microfinance institutions, sustainable agriculture, and other causes which they believe to be worthwhile. And again, it is from one impact investor to another, their priority may be different, but each of these areas have different social impact investor. Impact investing is a process of intentionally making investment with the aim of creating a measurable beneficial impact on the environment or society, and at the same time earning a positive financial return. And as Dr. Satya has told us, it is true. From a study that was done in 2017 by UNDP, it indicates that enterprises and investment firms that prioritize sustainability are big businesses, and they are not just growing, they are thriving. I think you can see for the locals, you know about Safaricom's emphasis on sustainability, KCB, EABL, Equity, among others. These are these four corporate giants in Kenya have even in their reporting, they have set aside a sustainability strategy for their companies. So, and you can see if you, for those people who are doing their their studies on sustainability and profitability, I would request that you look at these 4 companies and try to do your case studies on them, because, for example, Safaricom, when they shifted their focus into sustainability, and especially sustainability in terms of looking at the staff welfare, a lot changed, and a lot, their staff turnover reduced significantly, and a lot of their staff became very happy and they stayed for longer. And so, and there was a huge, a real growth. If you can get a look at Safaricom, get a look at KCB, EABL. And so it is clear that is sustainability is a major investment, and it will reap a huge return on investment. So a study was done 12 years after the UN-backed principle for responsible investment, and that study was done in 2017, 12 years after UN-backed principle of investment was launched. And the number of investment firms committed to sustainability grew from 63 companies to 1,715 companies with USD 6.5 trillion to 81.7 trillion in asset under management. This, you can go and read that report. The link is right there. So economic and social sustainability is a must. It is not an option. It is a must in today's business environment, and it has a lot of benefits. A corporate strategy focusing on sustainability can add brand value, meet consumer demand, increase efficiency, attract valuable talent, and create new opportunity. So there are components of impact investing, which are intentionality, where an investor sets out to exert a positive impact intentionally. Return, it should generate and it will generate positive returns on investment. And then measurability, the benefits should be measured and transparent. And that is where the reporting comes in, measured and reported. There is an increasing, impact investors are increasingly adopting the UN Sustainable Development Goals as their own. And this can involve mapping investment to specific SDGs or even more, thorough strategic alignment through the design of financial products specifically for their achievements. And this information, you can always get the information on which investment impact investors are available for various sectors, if it is energy, if it is agriculture, and the rest. You can be able, if it is circular economy and such, those information is available. And information about the impact investment institutions, they are on the slide, and I will be able to share this so that you can be, if you didn't know, you are looking for some impact investment institutions to look to know whose doors you can knock. I will be able to share this. The other emerging funding sources for sustainable development is crowdfunding. Crowdfunding is most commonly defined as the efforts by entrepreneurial individuals or groups, cultural, social, and for-profit to fund their ventures by drawing on relatively small contributions. Normally, there could be small contribution from a relatively large number of individuals using the internet without a standard financial intermediary, as per Molick in 2014, Molick statement in 2014. Crowdfunding is where entrepreneurs and minor company platform owners and individuals can support sustainable development by using crowdfunding. And This is clear. There are projects that have project financing through crowdfunding that is very popular right now, and more startups are and companies are entering the global crowdfunding market. An alternative, because it provides an alternative method for raising capital through individual investors. And in Kenya, for example, you can complete a solar project with 100% financing with zero upfront cost, thanks to crowdfunding through one of our partners. And other than that, we have people like organizations like Kiva, Green Crown, Eco Crowd. We have, there are quite a number of crowdfunding players in the market today, locally and internationally. There are those that will require you to have registration of a company in their preferred investment in the destinations. There are those that will be able to do those crowdfunding here. We have Mchanga locally for those of us who know Mchanga. That's one of the platforms for crowdfunding. A lot has been said about crowdfunding, and so there's a link there. Crowdfunding comes to fill in the financing hurdles and gaps, the financing drought faced by sustainable entrepreneurs created by a large institution that require a huge deal of collateral from upcoming innovative social entrepreneurs. So if, for example, collateral is one of the issues for you, you will need to, you can easily jump into a crowdfunding platform as long as you meet the requirement. There are other standard requirements for funding an institution that still is also standard with crowdfunding, especially for legitimate crowdfunding platforms, which you will not be able to escape. And I think we will look at that here towards the end. Another another source of funding for your sustainable development project is what we call the green bonds. Governments and corporations are increasingly turning to green bonds, and the market for green bonds is growing exponentially. Green bonds have a positive environment impact. Governments use security to finance or major sustainability projects. So efforts are accelerating to prevent misleading marketing information known as greenwashing. Of course, that is because there are quite a number of misleading information, and people will tend to there are a lot of scams, so you have to be very careful. Green bonds work like regular bonds, like regular corporate bonds, regular government bonds, but with one key difference. The money that is raised from the investors is used exclusively to finance projects that have a positive environmental impact, such as renewable energy and green buildings. And I think as the Nairobi University was putting up the building, I believe that they considered it to be a green building, and they must have found some funding if there was something like that at that point. With countries around the world stepping their efforts to reduce carbon emissions, the market for green bonds is booming. The first green bonds were issued in 2007, and the market grew slowly for nearly a decade, but it has started to take off. The market for green bonds is booming, as evidenced in October 2021. The European Union issued 14 billion of the bonds, the largest deal ever. And this is coming from the World Economic Forum, Agenda 2021, and you can be able to visit that site. There has been turbocharged combination of political resolve and investor appetite. So the green bond is expanding rapidly, and the annual issuance is likely to hit $1 trillion by 2023. And this is according to the Climate Bonds Initiative by Bloomberg. And as you can see, there was for a time when the green bond was the green bond markets started, there was very little uptake, but with the time we can be able, when we compare it with funding for the fossil fuel, we are now seeing at 2021 funding for green bond is for green energy is increasing as the fossil fuel funding is reducing, and so we expect that that trend is going to continue into the future. There will be a tipping point, which is towards the race to save the planet. And the other emerging, those not emerging, but like I said, we have used it effectively, is the power of collaborative partnership. It is not always about the money when you're looking for resources, and we have we can testify to that. In our 1 year of existence, we have used the power of collaborative partnership, and we have experienced that. And as we began, we were able to secure a partnership that gave us satellite and artificial intelligence powered instant soil testing and sensoring to help farmers, so that we are able to measure soil moisture, soil nutrients, soil carbon on a regular basis. And this we can do globally up to 10 meters or 30 feet. And we say goodbye to hardware and soil sampling. And because our desire and our focus is to help the farmer, not just to get enough income for their produce, but also to get incisive information, technology-based information to make the decisions in time to save him and to make to get the best produce. So we were able to do that, and that partnership came between Fairways and Bumitra, and now we have a technology in our hand. We can test anywhere. You just give me the location of your farm, and we'll be able to tell you what is the soil composition, what's the moisture content of your soil. Is your soil healthy or not? How are your plants? And you can be able to read it on real time. We can be able to tell you whether it's going to rain or not. You can be able to decide what you want to do. We are in that partnership again. We are able to do low-cost carbon removal and certified carbon credits. Farmers are able to remove carbon dioxide from the atmosphere at the lowest cost, half the price of planting trees. And we are able to get credits certified to relevant local and international standards in each geographical region. And now that, as we speak, we have submitted the technology for approval at Vera. Vera is the verifying body, the certifying body for carbon credits. And so that process is ongoing. And I think from next year, we'll be able to give farmers value for their money. And this is farm-based carbon credit, not tree-based carbon credit. So we are able to do that. And one other thing that we have been able to get through partnership, because our objective was to link farmers to the market so that they can get more income for their produce. And we did not want to just link them in other ways. Otherwise, we would just be other players in the market. So we wanted to do that through technology, and technology is using a mobile app. Because we started when the COVID pandemic had ravaged the country, and as a consultant, a business growth consultant, it was not possible to get clients at that time. So with a little income, we were able to do market survey, market research, and we did not have enough money to develop our own mobile app. But through partnership, we have right now a mobile app that we have developed that seeks to streamline the agribusiness supply chain, B2B and B2C linkages by connecting the farmers not only to buyers, but other critical players in the agribusiness sector, agrovets, agronomists, and AI soil testing technology. So farmers, agrovets, and households are able to connect on this platform. And we call it Klimo app. So if you see this Klimo app anywhere, in fact, look for it in the and I will share the link. For those of you who are farmers, you can download. I will share different links. There's a link for farmers. If you are a farmer and you have active produce, which you want to place in the market, you can use that link to register as a vendor. And if you are a consumer and you want to buy directly from farmers, whether you are an institutional consumer or you are running a grocery shop somewhere, you're a mama mboga or a major grocery shop in the estate, you can use that to buy your produce directly from the farmer. But also, we also give the farmers an ability to determine the minimum quantity, order quantity, so that if you are a small-scale farmer, you can directly link to the consumer who is buying 1 kg of potato instead of selling a whole sack. But if you also want to sell your minimum 1 sack, then the grocery shop will buy from you that 1 sack as a minimum. So that is the power of partnership that I believe we should not ignore. And so as we continue to work as Fair West Green Markets with our partners, we are also working towards providing a platform for guaranteed growth fund and income protection. This is, we are aiming to make agriculture attractive, or in other words, sexy for the next generation, so that we are able to feed as many in our growing population. The only sure thing is that the population is growing, and as population is growing, we are going to have many mouths to feed. We are working towards a system that will enable creation of guaranteed funds for so that farmers can be able to get linked to credit. And because they are trading in the platform, in the Klimo app platform, we can be able to set aside for every transaction a certain amount of money to guarantee them loans with financial institutions and guarantee them pensions. We are going to be the first, maybe if not the first, but one of the institutions, private institutions that will be providing pension for farmers. And so that you can easily go into farming as a business, not as not when you go back to up country that you're going to do farming. People think that you have failed umeshindwa na maisha ya Nairobi. That is what they normally say when you go to do farming. So another thing that I would present as one underutilized or unutilized source of funding for sustainable development initiatives is what we call capital stewardship. In other words, capital stewardship campaign. Now, capital stewardship campaign is an initiative that helps to generate resources from the social capital. For example, I am using Nairobi University as an example here. Nairobi University has students and alumni. The students and alumni can actually be your social capital, depending on how you treated them and how you parted ways. It's very important. So, and even workers, many people who have interacted with the university can actually be used to raise funds for a project, for a sustainability project. So your people will contribute needed capital to create a greater impact. And so sustainability is not just a matter of lip service. Sustainability is not sustainability without focus on human resources and social welfare. So I happen to be also, I would say an expert, but I've successfully run a capital stewardship campaign. There is a lot beyond the curtain, behind the scene work that happened before you launch a capital stewardship campaign, especially for when you're dealing with a large multitude of people. It takes many months, minimum of 6 months to prepare, and then it can run for up to 5. You can run a capital stewardship campaign for 5 years, and if you run it well, even if you say you are raising 100 shillings from every person who has passed through the hands of Nairobi University, you are going to raise so much money to be able to run a sustainability project for the university. And with that, I think all that present to us what we would call blended finance in a nutshell. And I quote from Julia Prescott, head of strategy Meridian, says, the private sector recognizes that donors need an effective framework in order to take blended finance forward to the next levels. These principles provide the step in that direction, which now needs to be taken. And in conclusion, I want to briefly look at why institutions are finding it hard to access available funding and resources. And it all boils down to the funding or investor readiness. There are many investors available, as many as has been indicated, more than thousands of investors that are willing to invest in sustainable development. But do you have sustainable business? Lack of funding is not the main obstacle to growth, as many tend to believe. The following are the main obstacles to growth, and they will also stop your institution or project from getting funding. In fact, if you ever get funded without fixing the issues, then your downfall is as sure as the sunrise and the sunset. One important thing to look at is your business idea. Do you have scalable business idea, or your business is if your business idea is unscalable and you lack innovation, then no investor is going to look at your business, or no investor is going to fund your business. What is your vision and mission? Are they aligned to sustainability agenda? You cannot align all your vision to all the 17 sustainability agenda, but at least identify one that you want your vision to be aligned to. And then there is what we call culture. Poor organizational culture will kill any strategy. If you have everything in place, you have a good vision, you have good managers, you have good strategies, you have a business idea, but you have a poor organizational culture, again, that boils down to the people. If that organizational culture is poor, it is going to eat you. It's going to eat the entire organization. And like they say, culture eats strategy for breakfast. Then finally, systems and structures. Do you have systems of accountability and systems of governance? If you have poor systems of accountability and governance, then all that is going to boil down to your failure as an organization, or your failure to get funded, because investors or funders are very keen to do their due diligence to determine this and many other factors before they put their money into an organization. Otherwise, I'm very grateful to have been part of this panel and this presentation. And I believe and I hope that the University of Nairobi, the premium university, is not going to leave this here as a discussion every year, but it is going to put this into action and implement it so that we are not ending up with policies that are gathering dust in our shelves, but we are actually implementing them. You are aware, or you may be aware if you are not aware, that most of the policies that are used across the world and across Africa are actually either drafted in Kenya or drafted by Kenyans. And so we do not lack, we are not in shortage of policies. We are only in shortage of implementers. And as we talk about culture, if you are interested in building sustainable business, I would recommend that you get this book, Business by the Book. Read it by Larry Bucket, and then you can join us on a weekly study session with other business founders. And you can email your expression of interest to grobisafrica@gmail.com. Then we can include you in that weekly study session. But make sure you get this because it helps you. Helps you to set the systems, the cultures in place from the founding of the business to hiring of employees, to compensating and issues to do with firing. And yes, and so you can be able to grow your business by the book. I am cognizant of the fact that we are not all Christians, but I know that Bible is one of the books that are used by many business people, Christians and non-Christians, and many successful businesses have used the Bible principles to run their businesses. And this book is written based on the biblical principles. To connect with us, you can, once again, we help farmers to grow, to connect, grow, and protect their income using Fairways and Kilimo app. Thank you very much. I will be available for questions.
Thank you very much, Esbon Goody. I wish you can hear our claps. That was a very elaborate and insightful presentation on agri-investments and funding, and also funding generally. And we'll get in touch with you, me personally. You have also raised issues to do with funding, the university funding, and these sessions are being recorded, and I hope the university will take some action when it comes to funding. You have dealt very elaborately on agriculture, and we face problem when it comes to agriculture. Our great-grandfathers were able to produce and feed themselves. Now here we are after 2,000 years, over 2,000 years and over, we can't feed ourselves. So what's the problem? You are telling us we can seek funds. And I now open the session for questions and comments on your presentations. To start us off, I think I have a question, just a small question on agents. Here in Kenya, we have a problem with agents agents are exploiting farmers. Agents are exploiting. What do we need to do about these agents? Because they buy very cheaply from the farmers and they sell very expensively. And I know even in your organization, you are facing problems with these agents. You can start answering that as we wait for more questions. Thank you.
Thank you, Dr. It's true that agents are exploiting farmers. And my experience before we started Fairways Green Markets, we did a study through one fellow doctor who was doing a study with the farmers in a section of the country, and we were able to work into connecting the farmers to the market. But then it was a physical market, doing collection from the collection center and sending it straight to the airport for export, and then we'll be able to distribute that. Now, one of the things that that make agents thrive is the desperation of farmers. Farmers get desperate in many times because when they want to, when the produce is ready, the market is, in many cases, is flooded. And so they get that kind of desperation. So I don't necessarily blame the agents, but I think it is the market readiness issues that we must deal with. And so when I was thinking about the Fairways Green Markets and how we can do things differently, we were able to. That's why we were able to introduce to put in place a mobile app. A mobile app will now connect the farmer. The farmer will in the mobile app. The farmer will decide at what price they want to sell. And on the mobile app again, of course, we continue to improve it day by day. We will put the information on the pricing so that the farmer knows what the market price is like, and we'll also be conducting trainings as time goes by, so that the farmer is aware of the market price, and the farmer can be reached from wherever. And so a customer in India can easily reach a farmer and make their order. A customer in China can make their order, and a customer in Nairobi can make their order. So the stopgap measure to remove the exploitation of farmers is basically technology.
Thank you very much, Esbon. I can see on the charts there are other questions on agents. They are asking, how can you eliminate agents? You have answered by indicating that the internet farming and the apps, you can do something. Any more questions?
Yes, Professor Sajid.
Yes, Esbon, thank you very much. That was a very enlightening presentation. I really appreciate the detail on the new innovative tools that you are using. And also I appreciate the statement about the uselessness of foreign aid. I think it's very clear through the example of Fairways Green Markets that everyone has to stand on their own 2 feet and to collaborate with others around them. That aid is usually not aid, but it's usually something that ties us down. Maybe if I could ask a little bit about the agents and the technology. I wonder, you know, it is often said that the technology can eliminate the middleman. It can make it so that you can have direct relations between the buyer and the seller. But I would caution that usually the technology is not enough. That is, the buyer in China, the buyer in India, they will not go to the small farmer that is selling them a few sacks of potatoes. They will need a middleman. They will need the agent, because they will need certainty of delivery. They'll need to understand the reputation of that farmer in a marketplace where you can connect the farmer with the buyer. That's good, but it's not enough. The buyer needs to understand the reviews of that farmer. How often has that farmer delivered on time and in good quality? I think the trick, and you said it yourself, it was very smart. You said that the farmer's desperation is the problem, right? And I think that the difficulty is to ensure that the farmer has many potential buyers. It cannot be that they just are relying on the buyer from China or India or Europe. They also have to have local buyers too, because their product is perishable. If they cannot sell in the next few weeks, then it's worthless. So that's what creates that desperation, which means that the local buyers have to be ready and willing. There should be a local distribution system also. Could you maybe elaborate a little bit on that?
Thank you, Dr. Satyat. You're very correct. So the need for agent is actually, we've actually addressed the need for agents in the platform, so that because we also understand that not all farmers are accessible to mobile phone, and not all farmers are accessible to smart. They may have a mobile phone, but it's not a smartphone. And even those who have smartphones, not all of them are accessible to internet. And so we have a distribution system where we have the agents. So we also enable agents to register. So an agent can have as many farmers on their platform, and they can be able to collect, and they can be able to deliver when the produce is required. And we have, like you said, we are at the stage of mobilizing as many buyers. And so we have a person in the market registering grocery stores, both small and large grocery stores, yesterday we had about 10 of them on board, with about 50 farmers that are registered, and we continue to register grocery stores, what we call the mama mbogas locally, so that they can be able to take as much from the farmer, because we know that the groceries, or mama mbogas, the kiosks are very critical in terms of breaking the bulk for the farmer. The individual household may buy a few units here and there. And in terms of the market, we are still, first of all, looking at the potential local market, the potential buyer, before we go outside of the country. And so that will be sorted through that. And so we are not completely eliminating the agents, but we are putting them in the system so that they will be able to earn an income, but not exorbitant income and leaving the farmer poor. Because we all know that farmers supply 70% of the food that we eat locally, but 80% of our farmers are poor. I can see a question from Isaac Wasonga. He's saying that it's an encouragement, but most farmers don't even have on a smartphone. And I think I've addressed that in addressing Dr. Satyajit's question. And also the milk market is very poor. Local seller is oppressed. How can this be addressed? For the milk producers, the milk farmers, we already have a dairy producer, a local yogurt factory that is interested to collect from farmers, from milk farmers around, as long as they're able to deliver up to a minimum of 1,000 liters a day. So we would welcome dairy farmers who feel like their milk is they're being underpaid, and they can be able to guarantee a minimum price per liter that would not change whether the market price goes down or not. And I think that is why Fair West Green Market exists. I'll be able to share my contacts on the chat, both the social media contacts and email addresses. We'll be sending that shortly.
Can I ask a question?
Yes, please.
Thank you, Esbon. Are you hearing me?
Yes, I can hear you.
Thank you for sharing about the Kilimo app. I think I'm getting to know about Kilimo app for the first time. I've never heard about it before.
You are not alone.
So I feel so many, and especially in the village, I've not heard about it, and yet it's supposed to benefit more of the people in the village. So I'm just requesting that you step up the campaign, the awareness campaign about this Kilimo app. And I also wanted to know about the cost of the app and the other services that you offer. You are talking of soil testing. How much does it cost? I think soil testing is very important. From my experience, I occasionally visit the village. Sometimes they just plant without, most of the small scale farmers, they don't do soil testing. So they end up growing wrong crops, which end up with low yields, mostly because they're growing crops that are not suitable for the soil. So if you can step up this service, I think we can improve the yields, especially in the village. You talked about training costs. Training, how much does it cost? Most people in the village, because of the low income, they may not be in a position to afford, because you charge. So can you partner with some of these people who are doing funding to offer this training at low cost, at subsidized cost to the village? Because this innovation it can really improve the GDP of Kenya and other countries. Then lastly, there's this book you have recommended, Business by the Book, Larry Bucket. Where can we get it? Which bookshops? Thank you, Esbon.
Okay. Thank you, Wycliffe. I'll respond shortly. Okay, Kennedy Okiro, Timothy, yes, Timothy has a question. He's raising his hands.
Sorry, Osborne, that was by mistake. You can
continue. Okay, thank you. So in response to Wycliffe's question, the cost for the app, also first, the app is new because, like I said, Fairways Green Markets is very new in the market. We were registered in 2020 in October, and we started by doing the market research, going down to the villages with farmers from Kisumu to Makueni, and getting to get their feedback. So it has taken us some time to come up with the final, and even the app which we have been improving. Even right now, the more improvements that have been uploaded on the Google Apps for approval. So it is still very new. So you are not alone to hear it for the first time, and we will continue to heighten the campaign. The download of the app is free. To register as a farmer is free, at least for now. To register as an agent is free. To register as a grocery store, as agronomist, as an agrovet is free. So you can be able to register. I will share the link again. I will share the link on the chat shortly. So for soil testing, we normally charge 1,500 shillings per acre, and up to, yes, we can do testing for at least 1 acre and above. And so the 1,500, if you know your location, you send us the pin location of your farm. You stand at the middle of your farm, send us the pin location. We will be able to run the mapping of that area, that location, and then be able to give you the result. But if you don't know the location, that means somebody has to go to where you are. That then you pay 1,500 per acre plus transport. But we encourage people to send us pin location so that the cost is not as high. That is what we do. The training cost would vary depending on the number, and again, we welcome partners to partner with us in funding the training costs, so that we do not end up charging farmers exorbitantly, but we can discuss that for people who are available for individuals or institutions that are available for partnership. My only caution is that don't use it as a political tool. If you are interested in vying for political office, let's not use it. We will not be able to partner with you because politicians go down with that, and there's a certain expectations of the people on their politicians. So we've burnt our fingers once. We partnered with a political aspirant once, and the information that we gave them was completely wrong, and we ended up not being effective. So, but we can partner with any other institution or an individual as long as they do not have a political interest. I think that is important to note. The book, Business by the Book, is available online and is available on Amazon. And I think a few bookshops here would be would be able to get it. If you are interested, you can send me the email, an email on the email that I've shared. Then we can be able to do. I can be able to talk to a few bookshops which can be able to order it for on your behalf. But you can also order it on Amazon.
Thank you very much, Osborne. The questions very well, and I think you have handled all the questions. Even the ones on the charts, I think you have handled them very well, and thank you very much. Now, I'll go back to Dr. Eli.
Thank you.
So that we can move to the next.
Thank you, Dr. Kiro. Thank you, CPA Hesburn and Professor Sajid for very top-notch keynote speeches. You know, you have kept my attendees here for all this while. They just keep buying data and they come back. I've been monitoring their behavior. Now we'll take about a 10 minutes commercial break, after which now we will get into academic paper presentations. If you are in the attendees section and you want to present a paper, please raise up your hand so that we can promote you to be able to be a panelist and present your paper. But now Hesburn has also put his email address on the chat. So those who are asking for his email, you can get it from there. So please, let's take this 10 minutes break, come back for the academic paper presentations. We're not done. It's going to be more interesting. And see you then. Let's take the break. Dr. Gatau, are you ready?
Oh, yes, Dr. Eli.
Okay, I can see you. Maybe you can present your screen.
Good evening, everyone, and good morning to those who are in other jurisdictions. My name is Dr. James Gatawa from Kenyatta University School of Business. I'll be making a presentation on private equity financing and financial performance, taking a context of fintech firms. Nevertheless, my paper is a conceptual paper or a critical review of literature. Now, I've organized my presentation in four particular sections. I'll make an introduction about the paper and then move on to talk about literature review and summarize some propositions of this paper and make a summary and conclusion. Now, first of all, we need to note that private equity is emerging as an alternative form of financing for various types of organizations, ranging from SMEs, corporate entities, and even startups. We do know that the mainstream or dominant form of financing for firms have been debt sources like bank loans or even trade credit. And also on the other extreme for equity financing, what has been common is a case of, especially for companies, making or rather issuing their shares. But private equity financing is a form of financing for firms whereby this would be raised from a particular fund that of course sources this financing from high net worth individuals, from various organizations, could even be DFIs or other types of entities, of course, in expectation of a particular return. Most of the times, some additional minimum requirements for an organization to qualify or access this private equity is that they should be a firm that is offering products and services that are highly innovative, and the firm should have a high growth potential. Now, this whole particular issue of private equity financing, from the East African Venture Capital Association report of 2017, we've seen a shift of PE funding from agribusiness sector to now financial services and manufacturing sector in the East African context. And this particular shift of PE funding could be because of now increased attention or focus on value addition and services sector. But then the key pertinent question here is, would PE-backed firms have a better performance than non-PE-backed firms? In my next slide, I seek to explain briefly the key study variables for this particular paper. One is private equity, essentially being the equity financing that is issued by a PE fund or a venture capital fund to young or mature firms with a high growth potential. I must say that if you check extensive literature on this whole issue of private equity, there are those particular studies that interchangeably use the terms with venture capital. But essentially, if you are to strictly look at the description of private equity, it encompasses venture capital, and now, of course, leverage buyouts. And in this paper, we include also private equity investor characteristics and PE strategies as constituting this whole broad term called private equity. Now, another variable that is under focus in this paper is financial performance, which we all know is about establishing how well a firm uses their resources to generate revenues or profits. We know that there are various or numerous parameters of financial performance that range from profit margins or focus on profit margins. And there are those studies that look at performance in the context of using parameters looking into returns or using the economic value added approach. But essentially for this particular paper, the focus on financial performance is on returns or returns on equity and return on assets. This paper also looks at another variable, which is firm factors, which you may look at them as control variables or a moderating variable in the context of looking at private equity and financial performance, of which these firm factors encompass the size of a firm and the growth levels of a firm. Despite this paper being a conceptual paper or a paper looking into a critical review of literature, I also took a chance to look at briefly fintechs, which is essentially a case where a firm is leveraging technology so that they may offer some financial services. And we know for these fintechs, there are very many, and we've seen the emergence of these fintech firms in Kenya, especially over the past few years. Those that focus on payments and savings, like M-Pesa, PesaPal, Jambo Pay, iPay, and so on. Others focusing on lending. Think of fintechs like Tala, Branch, Zenka, and so on and so forth. Or others looking into financial services enabling, like Jumo, Farm Drive, and others. Now, again, if you look at East African Venture Capital Association 2017 and 2018 reports, these reports argue that or acknowledge that the East African region has been undergoing a financial revolution due to various factors shown on the page, ranging from changes in demography or demographic trends to do with the digital infrastructure. Think of even the whole issue of financial inclusion, improved financial inclusion, the issue of data and technological trends, and gaps in the financial services market. This whole issue, again, especially in the Kenyan context, think of this or look at this from about even 2016 with interest rate capping. Around that period in the capping regime, we've seen increased uptake of fintech services. Now, my next page I highlight the research problem with regard to this paper. I've said moments ago, this paper takes up a conceptual research methodology. And the first point here is that when you look at this link between private equity financing and financial performance, debate is inconclusive. On one hand, you'd find that there are studies arguing that PE-backed firms would have better performance. In my literature review, some of these studies ranging from studies done by Salano in 2019, others done by Meles et al. 2014, and others. Well, on the other hand, there are still studies arguing that the issue of PE financing is financing just like any other and may not necessarily translate to superior performance to a firm that has not received private equity. Studies arguing in this, like Davis et al. 2011, amongst others. A second point here is that this whole, we have insufficient empirical evidence on the key influence or effect of firm factors on the relationship between private equity and financial performance. And lastly, the interrelationship amongst these three key variables I've just introduced in the previous slide has not been integrated in one Kenyan study or single study. And therefore, these three key points forming the statement of the problem or key gaps in this paper. Now, in my next slide, I highlight the key objectives of the paper. One being to examine empirical and theoretical literature on private equity and financial performance. And two, to examine the conceptual link between private equity, firm factors, and financial performance. Now, moving to the next key section is on literature review. This paper had two key theories that underpinned the study. One is the agency theory, as key proponents are Jensen and Meckling. But of course, in arguing about the principal-agent relationship, they had borrowed on the works of Valchian and Dempsey in 1972, and of course, other previous scholars on the same. Why this agency theory is brought in here is to underpin this link between private equity and financial performance, more so with emphasis on performance, because we know that this theory mainly argues that agents of a firm should act in the best interests of the principal, who are shareholders or owners of a firm. We know that mainly a company or a firm may adhere to this key objective of shareholder wealth maximization or stakeholder satisfaction. And therefore, this theory is underpins that particular link. Then the second theory applied in this paper or underpinning this paper is on diffusion of innovation theory by Rogers, 1962, where Rogers talks about the aspect of adoption of innovation in firms. And therefore, considering that I've earlier mentioned that private equity financing is mainly dispersed to firms with high growth potential, or rather have adopted innovation in how they offer their products and services, then that's why I've used this particular theory to underpin that relationship. Now then, in my next slide, I highlight just selected empirical studies that constitute the empirical literature review of this paper. If you look at private equity and financial performance, I've selected or rather captured studies undertaken in different contexts, a majority of them in developed economies, studies done in the US, a few in Europe, and a few in Kenya. I must say that this whole area on private equity has not been extensively studied. No wonder you'd see substantial studies done on private equity and financial performance. That particular link is studies done in the US, a few in Europe, like for example, studies by Tekvova and Borrell 2012, looking at the European context, Salano and others, European context, and others looking at country context like Laman and others in Germany, Kalidas and so on, New Zealand. Having said this, the next particular page highlights the conceptual framework of this paper, or essentially the diagrammatic representation of interaction of variables in the paper. On the left side, I have independent variables, of course, touching on private equity. And on the right-hand side, we have the dependent variable, which is essentially financial performance. Now, what I've not indicated in this diagram is the propositions of this paper. The direct effect conceptualized here, that is a link between private equity and financial performance, forms the first proposition, whereas the second proposition here is with regard to firm factors having an influence on the link between private equity and financial performance. Firm factors picked here being firm size and growth. Now, this particular conceptual framework developed as a result of the theoretical and empirical literature reviewed, forming the basis of this particular framework. Now, the propositions for this particular paper are: one, that there is a relationship between private equity and financial performance. And the second proposition being that firm factors have a moderating influence on the relationship between private equity and financial performance. Now, I make some, as a result of reviewing theoretical and empirical literature, I came up with some summary. One is we have some inconclusive debate on this whole link between private equity financing and financial performance across various regions. And two, an issue of mixed findings on the extent to which growth and firm size would affect the link between private equity and financial performance. Now, the third summary here being that in the period of 2010-2017, we've experienced a rapid growth in private equity financing in the fintech sector. Of course, as shown here on this slide, getting to the extent of $2 or $3.5 million, which was essentially substantial funding to Kenya of over 90% when you compare to the other East African countries. That's finding noted with regard to this particular paper. Now, there are some areas for further research that this paper recommends, mainly three of them. One is undertaking of a comparative study on private equity and financial performance in private equity backed firms and those that have not received any form of private equity. Number two is second area for further research made here is that undertaking an empirical study on the link between private equity and financial performance in various sectors, like the real estate sector, agricultural sector, fintech sector, amongst others. And a third area for further research made here is that exploratory studies can be done on the link between private equity and financial performance across the East African region, or on a regional or continental context. Having said this, that marks the end of my presentation on private equity and financial performance. Thank you. Back to you, Chair.
Thank you, Dr. Gatawa. Members, any question? Any question for Daktari? If you have a question, you can raise up your hand, then I'll be notified. If somebody has a question. Right, I can't see any hand raised. Dr. Gatawa, you can bring down the presentation. There's a question cited from Wycliffe. Yes, Wycliffe. Wycliffe has a question.
Thank you, Dr. I have a question.
Yes.
Yeah, I'm a student, a PhD student in the UN. And I'm glad actually I'm learning a lot of things. So I just wanted a clarification. When you're making the comments on your conclusion and summary, for further studies, you say a comparative study can be done. At the same time, you also say that an empirical study can be done. What's the difference between the two? Comparative study and empirical study.
Daktari?
Yes, thank you, Wycliffe, for that question. Quite a very good question you've raised. One, when I say that a comparative study can be done, this is more of undertaking a study where you have like 2 data sets, where you are observing firms that have received this PE funding, and observe their general, link that up with financial performance and see the outcome. And then on the other hand, still have another group of firms within a particular, the same sector, that have not received the PE funding, and see their ultimate outcome, or rather performance. So that now being the comparative study. Now, when I make a mention about an empirical study, this one is why you'd simply say that you are going to study a particular sector, gather data, let's say, for example, the fintech sector, gather data on the entire sector, and then look at it in a sector perspective, where you don't discriminate between those that received the funding and those that did not. That's what I had in mind, or rather, that's what would essentially constitute an empirical study. Or essentially, when I say empirical study, that's what I had in mind. But in essence, when we say empirical, we always think of the next extent of data collection and do some analysis and make some inferences. But when I said comparative, I meant having, comparing those that have received the PE funding, those have not. And when I mentioned empirical, I had in mind a case whereby you look at it in a sector perspective or a country perspective.
Thank you, James. I hope that has been answered well. Now let's have Okwata. Okwata had a presentation. Fine, I'll presume that Timothy has no questions from the participants. So, Timothy, thank you very much for that presentation, work on the paper, and hopefully in the next conference you will give us a full paper. I'm looking for Dina Muthoka. Dina, if you are in the attendance, please raise up your hand so that we can have a discussion, Dina. But let's get this opportunity for Tom Okungu. Tom, please share with us your presentation. And I can see
something on the screen. Thank you so much. Thank you so much, Dr. And my models who are there. Tom Okungu is a PhD student at the University of Nairobi. And most of the lecturers there are familiar to me. And it gives me a lot of joy to present my project today, titled Anti-Fragile Risk Governance, Coping with Black Swan Events. In fact, when I was doing my research, I found that even very experienced risk analysts and auditors had a problem with the key terminologies you have used there, anti-fragile and black swan event. I'll take a bit of time to explain that as we go along, and to explain that as we go along on my presentation. That's our topic. Now, the next slide is on our, I don't know why it's not responding. Yeah, that's the next slide is our introduction. I'll take very few minutes. You have allocated me around 15 minutes. I don't want to spend a lot of time on this. Let us just get into it. The motivation of me doing this research is that I felt that the traditional risk assessment that is being employed in most organizations are imperfect, and though they are well tailored to deal with the routine kind of risk and the normal risk in the operations of companies, they are not really tailored to deal well with the black swan events. And the reason why the current traditional risk practices we are having are not well tuned to deal with black swan events is, one, they are fragmented. They are really fragmented. They are done from one department, like it's only financial. Most of risk analysts, as we'll see later on, most of them are done by internal auditors. You don't even have a standalone risk department. So they are fragmented. They are not holistic. If they are holistic, they'll be able to cover not only the financial risk, but they'll also be able to cover other non-financial risks in other departments like the health sector, the safety. As you can see, COVID-19 is not coming from the financial sector. Then they are reactive. Most of our risk assessments are reactive and not proactive. And you cannot analyze risk by looking at the rear view. We are reactive. We are kind of reacting. We are like firefighting. We are looking at it from the rear view of what has occurred in the past. We are not, our risk system is not forward-looking and is not futuristic. Then our risk system also, just like other speakers have said here, I was listening, is more focused on threat. Just threat hazard. It's just about hazard. You don't think that this black swan event, like what we have had under COVID-19, they also bring with them some advantages. Like I'm now able to deliver my project here through online. It's an advantage. We never used to have this before. Then also this system is discontinuous. You look at that, it's discontinuous. It ignores some other risks. And this is what, in terms of risk officers, we say about one of the treatment of risk is accepting risk. And what do you mean by accepting risk? You are ignoring some very important risks. And we will look at that as we go ahead. Then it's cost-based. We are just, it's cost-based. And the problem with this also is the fact that most of the risk analysis are being done by internal auditors. And internal auditors are trained in such a way that they look at inherent risks. Inherent risks are those risks that are prone to misstate the financial statement. So they only look at the financial statement. and risk that are prone to mislead the financial statement and ignore financial risk. We have talked about our traditional risk system is more focused on rear view. We tend to look at the past experience. When I was looking at most of the risk registers, they are static. They are not developed with emerging risk. And that is why I truly feel that COVID has hit us so hard, and the people who are responsible for this, who we can't exonerate, are the risk officers. Then the internal control system, I've mentioned it. One of the key responsibilities of governance, as we know it, is the way organizations are controlled and directed. They are the ownership, and the most important factor that we study about governance is because of separation of ownership and control, and also the activism of shareholders, so that as we are responsible for directing companies, we do it in the interest of shareholders. And internal controls, which is an aspect, is mostly financial, the way we have seen. They tend to look at risk of material statement, financial. And because the financial issue is so immense, they have just very little time to look at the risks which are really threatening the existence of most companies in a holistic manner. Then also, our risk assessment is based wholly on probability. The risk assessment we have in the traditional risk assessment is far more based on probability. And it's based on probability, and especially we look at that. The risk process involves risk identification, risk analysis and evaluation. When it comes to risk analysis and evaluation, we tend to use probability a lot, because we say risk is a product of the likelihood of the occurrence and the exposure to the consequences, the catastrophic consequences. So it's probabilistic kind of nature, and as we see it, we tend to ignore the outliers, and the outliers are ignored in such a way that when we say that the kind of treatment we are giving this risk is acceptance of risk, we are saying that that kind of risk, we can live with it. And again, it seems like the risk, we have already said that it overlooks that financial risk. And you can see the kind of risk which has given us a lot of problems is not coming from financial risk. This risk is coming from non-financial risk, which has brought a lot of threat of going concern. And now most of the audit reports you see, they have emphasis of matter paragraphs, which is saying that the going concern of this organization, the way me auditor have looked at it, is really threatened. Then also, when it comes to risk evaluation, we have a problem with estimating the likelihood of occurrence. It's not very possible, especially for outliers, things which is unpredictable, we don't know about them, they are rare on occurrence. Then even the experts, even as experts here, we really can't give a good forecast of unexpected and unpredictable risk, which we are referring to as the black swan event. We look at that, and that forms our motivation. Motivation is fragmented. We have talked of that. We have talked of looking at the risk from the rear view instead of futuristic. Even driving, even when you are driving, you can't be driving always in the rear mirror. You're just looking at the rear mirror, you have to look in front. And that is why we are postulating that now the risk officers, we need to think of our risk assessment procedures and start focusing and anticipating risk, because the shareholders have given us the responsibility to take care of their financial investment, and an excuse like COVID is an outlier really, they won't take it for so long. If another risk comes and it really stabilizes cooperation, the shareholders won't it as very likely. Then we'll just take you through quickly on the variables. Those are variables of study, Black Swan event. I'll spend a bit of time in explaining Black Swan event because even when I was doing out interview outside there, most, even the very senior risk analysts had a problem. They kept on telling me, can you explain to us what is Black Swan event? But after I'd explained, they came on to concord and say, we know it. So we'll spend a bit of time there. That's the independent variables, Black Swan event. Then return on shareholders' investments. That is our dependent variable. And corporate governance is our intervening variable. And then anti-fragility. I don't want you to say to ask me what is anti-fragility. Just take it like a risk assessment. And when it comes to risk assessment, because it affects the relationship between the independent variable and intervening variable, when it is risk assessment, we call it the mitigating effect. But when it comes to research, it becomes our moderating variable. Those are variables for the study. Then we look at let's see what is Black Swan event. Wow, magnificent bird. Look at it, the Black Swan event. Black Swan event is normally used as a metaphor in the medieval Europe countries before the discovery of Australia. Most Europeans believe that all swans, swan is just a bird. All the Europeans believe that all swans were white because they had not traveled far beyond Europe. But when explorers came and one of them was able to travel up to Australia, he came back and told those Europeans that I saw a black swan in Australia. What does this one mean? It only means that it should not base our, it's the induction problem. That is what most researchers call the induction problem, that however much we observe something in the past, we should not conclude in totality that that is the belief. You can just spotting one observation which is contrary to our belief will negate the whole of that belief, will negate the whole of that conviction we have had. So that is the Black Swan event, and this one, this really affects risk assessment. When I was moving around corporation, then I was asking them, do you have risk register? Most of the risk register, what I've observed, they are static. They have remained the same the way they were many years. The risk registers are not improved. And one of the reasons we see that in the finding, because of combining risk assessment and internal audit. We'll see that in our finding. So we have talked about, and that is a Black Swan event. Black Swan event, take it is a metaphor. Is that however much you observe that over infinite number of years, you observe in your locality that all swans are white. We should not conclude that all swans are white. If you can travel widely, you go, the world is big, you can go somewhere the way David Hume went to Australia and discovered that there are also black swan in Australia. So the problem also when it comes to risk analysis is this idea of grouping, of doing risk analysis. And here it is. We tend to, the way we do risk analysis, the traditional risk analysis is we tend to group our risk. Once we have identified them, we tend to group our risk in terms of the vital few, represented by the red there, that these are the vital few. And these are because they have high likelihood and they have high consequences. Then these are the risks we need to deal with. Then we ignore the ones in green. Either is in green because the risk is a product of likelihood and consequences. We'll also be ignoring the ones with huge consequences, but with very rare likelihood of occurrence. And this one makes us to be unprepared to face risk. And this is why most of organizations with the the kind of risk. I always am very humble when I go even to my place of work. I see now there are places for washing hands. It has taken us very long to realize that we should have places just for washing hands because of this way of grouping risk. You group risk and it follows. This is the Pareto distribution. Most of them use Pareto distribution where you cluster together the vital few and you treat those ones, and then the minor trivial, the trivial represented with green, the minor trivial, this could be numerous of them, and you could see the way the minor trivial is coming up, the green, the green boxes we are representing there. Some have very huge consequences, extremely catastrophic events, but because they are negligible, they end up on the green squares. And as a risk analyst, we want to escalate that one to the governance people. And I think I need to show you my next slide there, which is this one, this slide here, that slide. Now, once we have categorized the risk in terms of vital few and the trivial many, we then come and cluster them in terms of extreme risk. Then we also cluster them in terms of high risk and moderate risk and low level risk. And you can see the low level risk remains at the directorate level, the people who did risk analysis, because these are low, but you can see the risk, the way they came up to the low risk, it was a product of likelihood and the effect of consequences. But now, this one remains at the directorate level. They are not escalated up so that they can be dealt with the people in charge of governance. And this is why for a very long time, we have not even had, even for very sophisticated institutions, they have not even had just a place to wash hands. So that's how, that's the real problem there, the real problem of a risk analysis. And I want just to spend a little on black swan events. What are black swan events? We have said is that no matter how many times you observe the white swans, please, because we are researchers, the induction problem, let us not conclude that all swans are white. And black swan are used as metaphor to refer to unpredictable events which are of very huge and huge consequences and catastrophes.
Tom, speed up a bit. We are time bad.
Yeah. Thanks a lot, Dr. And now that's why I'll go to our conceptual framework because I know the time is the risk assessment and the fragility, black swan events, the way we have seen corporate governance, then return on shareholders' investment. The theories we have used are inventive problem solving theory. This inventive problem solving is one which was postulated by Jen Rich. And Jen Rich is just talking about inventing. We need those to come up with inventing of problems, and then you look at how it's being solved. Because the knowledge base of black swan is very rare unless you come up with inventing, trying to invent problems and looking at the weak areas in our system. Then also we have looked at anti-fragility theory. The anti-fragility theory is one which has been proposed by Nassim Nicholas Taleb. Things that gains from disorder. We want our institution to be in such a way that they are robust, and in case of any shock family, the disorder, the extreme events, the shocks, the failures, and the time they can gain from those disorders. Then also Finatian has talked a lot about uncertainty, and one of why I use this, what interested me on this, even Finatian said that uncertainty, you can't use probability to detect that. Then anti-fragility, the way we are proposing to assess now our risk assessment going forward, we should use the probability way of likelihood and the consequence, but also we need to use the triad, the anti-fragility triad, which is this one, anti-fragility triad. Let us always be much more, we look at our system and try and assess it. This particular process, just looking at it, is it fragile? And Martin talks well about it when he even talks about the huge debts that we are talking. Most of these, our developing countries are now in huge debt now, problem. Even just, you don't even need to do risk assessment on that to see that that is a catastrophic, it has catastrophic consequence, and it's just a matter of time. So we view our system in such a way that every process and product, try and evaluate it and check whether it's fragile, and nothing is fragile over glass. When you just see a glass, you don't need to be told that it's fragile. You just look at it and say, this one, if it is subjected to any shock, it just falls down, it will break. And that is the kind of system, so that we improve on our system, they become robust and fragile. Our methodology, we use descriptive kind of research, and we look at our population. We got our population from state corporation audited by external audit, and also the listed companies, which was 69. Then we took a sample, and the sample we also was certified random sampling. We were kind of skewed toward sectors which have been impacted so much with COVID-19, because our research looked at that at Black Swan through the lenses of COVID-19, and we look at sectors like aviation, we look at sectors like hospitality, transportation sector, construction sector, professional sector, and because of COVID, we use also online interview. We use some Zooming because it's a new kind of thing, and it's a new emerging thing. And we look at the panel. I got, having been a former financial officer and also an external auditor, I have many friends who are in risk analysis. We formed video conferences, and they helped me to get a view on this. And our findings, one of our findings, we now need to have separate risk departments. It's high time we have separate risk departments. Most of the organizations are visiting, including even universities, they have combined internal audit with risk department. And internal audit tends to concentrate more on financial issues and inherent risks which affect financial statement. Then our risk register, there's a big problem. It's not being updated. It's like we are kind of saying we have seen the worst of risk so far, but COVID-19 has taught us that we have not seen yet the worst of risk. And when it comes, I also we pose questions: what do people believe is the next black swan? Most people agreed that climate change, which will be manifested by drought, famine, and flooding and earthquake, maybe the next big swan, and all black swan, and also digital disruption. We are now delegating all the functions being done by human beings to computer, including data storage in computer. If you lose that data, it will be a huge black swan. Also, payment, all our payment now is being done through computer. We are discouraging physical payment, is non-physical payment. And I think that's why most people believe that the next black swan will be climate change and digital disruption. Because my time is up, let me just exhort the risk analysts who are here and those people who are charged with governance of risk. You know, risk governance is people who are charged with risk governance are the people at the top, the directors. That is their responsibility. The responsibility of directors is internal control, preparation and presentation of financial statement, and then risk assessment. That is the top post. Then they delegate it to the chief risk officers, they delegate it to everybody in the company, and shareholders, those shareholders have excused us for the COVID-19. They won't be lenient enough. There's a saying in China which says, China, you know, has gone through all these black swans, but they have been anti-fragile. They have been gaining from those shockers. And there's a saying which goes that to err is human in China. They say to err is human, but we don't forgive it in our company. So very soon, the shareholders, these people in charge of risk, be aware shareholders are coming for you. Thanks a lot, Daktari. I've taken short time. I had more slides to share, but thanks a lot. That's the end of my presentation.
Yeah, thank you, Tom, for that presentation on Black Swan. At least these are new concepts that are emerging in finance, and I encourage our students to really research more on this. So any questions for Tom, members? Of this Black Swan, seemingly they are trying to understand it. On behalf of the Annual Development Finance Conference Committee 2021, we are very grateful for your participation for the last 2 days. Good quality keynote speeches, good quality papers have been presented. All I can encourage you is you work on the papers if they are still working papers. You've learned new things, and present them to us. Either you present them for publication in our journal, that is the African Development Finance Journal, which has started to get traction in Africa. I'm already getting papers from as far as Chad, Egypt, and India. So please, if you have a paper, publish with us. And also you get ready for the Annual Development Finance Conference 2022. See you then, and God bless you. Thank you.